Today is Monday, February 23rd, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, Mark Bowman, and JP Steiner, all from the ADMIS Research Team. Starting with JP this morning, what does Friday's Supreme Court ruling mean for the markets, JP?
Long story short, more uncertainty and confusion. Friday's ruling was initially welcomed by equity markets and sparked more of a risk-on tone across markets after most of the Trump administration's tariffs were struck down. However, sentiment has shifted broadly since. The indexes and the dollar are trading lower to start the week as investors have been flocking to bonds and gold. President Trump announced on Saturday that he would be imposing a new 15% global tariff on all imports entering the U.S. effective immediately. The new tariff will replace the 10% global tariff that Trump announced Friday, shortly after the Supreme Court ruled that much of his existing tariff regime was illegal. To impose the new tariff, he is turning to a legal tool called Section 122 of the Trade Act of 1974. Broadly speaking, the provision has never been used before for tariffs, but does allow a president to impose tariffs of up to 15% for as long as 150 days to address problems caused by persistent trade deficits. Regardless, there are plenty of questions for markets and especially for companies who have paid plenty in import duties who may be looking for a refund from the federal government now. The government may have to pay back up to $150 billion to $200 billion to U.S. and foreign companies that had paid the duties. This could boost automakers, consumer goods, importers, and other sectors as well. But more or less, the broad uncertainty over what the trade picture looks like is likely to weigh on sentiment for the meantime. Notably, too, that the Supreme Court justices did not address the specifics of whether and how the refunds could be handled. In his dissent, Justice Brett Kavanaugh even said that the situation could become a mess. Critically, too, though, for bond markets, the ruling also cast doubts over what forecasters said could be trillions of dollars in revenue over the next decade to service the roughly 30 trillion pile of government debt that the U.S. has. This could add to growing market unease over the size of the U.S. government deficit as well. However, this is still quite a developing situation, and it will take some time to assess what the deficit is going to look like moving forward. One forecast from the Budget Lab at Yale estimates that even with the new 15% tariff, the U.S. Still has a lower effective tariff rate than it did before the Supreme Court ruling. The effective tariff rate was around 16% before the ruling, fell to 9.1% immediately afterwards, and is now estimated to be back at 13.7% because of the new tariffs, or I should say 13.7% because of the new tariffs. Now, several countries have also put a pause on implementing their trade agreements with the U.S., so that leaves a lot of these agreements that have been put in place over recent weeks or months in limbo. Broadly, for markets, though, this past weekend's events are likely to weigh on sentiment and business outlook and bring heightened focus to what the administration does on the trade front once again.
And JP, how does Friday's PCE data shape the Fed outlook now?
Yeah, so before all the Supreme Court madness we saw on Friday, we did get a mix of data that does continue to support a pause from the Fed. Starting off with fourth quarter GDP figures, real GDP increased at an annualized rate of 1.4% in the fourth quarter. That is a sharp deceleration from Q3's 4.4% growth. But the slowdown was primarily reflected declines in government spending and a drop in exports, alongside some softer consumer spending. The government shutdown also subtracted roughly 1 percentage point of growth from the Q4's headline figure. Despite the slowdown, though, real final sales to private domestic purchasers rose 2.4%, signaling that underlying private demand was still roughly remaining intact. Now, that figure certainly marks a slowdown from third quarter's headline growth, but I don't really think it's as bad as it seems, as the headline figure makes it seems, given that Q3's strong growth and the shutdown's effects on Q4's figure as well. Now, moving on to the inflation front, headline PCE rose 0.4% month over month in December, while core PCE also increased at the same rate. Both those figures were above forecast for a rise of 0.3%. And on a yearly basis, PCE inflation, which I should note is the Fed's preferred inflation gauge, rose 2.9%. That's a step above the previous 2.8 reading percent, while core prices also rose to 3%, up from 2.8%. Market priced odds shifted little following the data, suggesting that there was some expectations of a higher inflationary print, although July's meeting right now is no longer fully priced in for a cut, though markets are still favorable for a reduction come July, and especially during the summer. Still, though, the data pointing to a patient Fed stance, inflation has come back into the spotlight for several FOMC members in light of January's FOMC meeting minutes, which suggested that with a stable labor market, policymakers would like to see further progress on inflation before moving ahead with any easing. So for the Fed, they would like to see some sustained progress on inflation before making any further adjustments to policy. And if we get some hotter than expected inflation prints, that could continue to push back timing expectations. However, baseline forecasts for the inflation outlook do trend downwards, and policymakers are largely expecting inflation to continue to ease over the coming months, but certainly the pace of which is still unknown.
We'll continue to watch those inflation numbers. Let's stick with the theme here a little bit, Mark Soderberg. How will Friday's Supreme Court ruling impact trade in the ag space?
I think there's still just way too much uncertainty to know for sure. I think more than anything, the Supreme Court ruling will continue to just cast a cloud of uncertainty over U.S. trade moving forward. Shortly after the High Court's ruling on Friday, the president did impose across the board 10% tariffs using Section 122 from the Trade Act of 1974, which he then raised to 15% over the weekend. This act, however, does limit tariffs to only 150 days. With anything longer than that, that would require approval from Congress, which I think at this point would appear unlikely. In addition, the White House has clarified that exemptions for goods shipped between U.S., Canada, and Mexico would remain, according to the plan, remain in place. And according to U.S. Trade Representative Jamie Greer, individual trade deals with China, the EU, and South Korea would remain in place despite Friday's ruling. This remains to be seen, however, as already has some fallout as India they've canceled a visit to discuss trade here with the U.S. this week. Also, the EU is threatening to slow the ratification process of a trade deal struck with the U.S. late last year as they seek additional information on how this 15% tariff would impact this deal. So now, of course, what also happens to the $160 to $180 billion in revenue collected so far, since the Supreme Court did not order the immediate refund. I suspect the Trump administration, they're going to be a little bit reluctant to just hand this money back over, contending that particularly for companies that they would say they've passed along these higher tariffs onto the customer via higher prices. As it comes to China, it would appear that the odds of them buying more soybeans from the U.S. at the request of President Trump, the odds of that would seem to be on the decline. However, soybean prices, after a lower start overnight, they've turned around trading 10 to 15 cents higher now. And I think this is largely due to surging soybean oil prices as market continues to brace for higher biofuel mandates from the EPA. There's still just way too much uncertainty that exists out there, especially when you consider President Trump is visiting China here in just 5 weeks from now.
Mark, looking at wheat specifically, do you think the jump in wheat prices is sustainable?
Well, since peaking in 2022, shortly after the Russian invasion of Ukraine, every single wheat bounce or recovery has been a selling opportunity as prices have recently fallen down to 5 or 6 year lows by recently, I guess, last fall. This last recovery now has taken prices back up to the highest levels in 7 months. We're roughly 70 to 80 cents off those fall lows. I'd argue that this is largely due to fund buying, as speculators, I think, are just reconsidering their ability to profit from being short wheat. Speculative short position in Chicago is now down to probably around 50,000 contracts. That's a third of the record short position. And in similar situation in Kansas City, that short position now is only down to about 10,000 contracts. Its largest position there was about 80,000. I think the fundamental reasoning behind this all is also just growing drought conditions, lack of rain in the U.S. southern plains. The U.S. Drought Monitor last week showed that 46% of the winter wheat was in drought. And that's the highest in the last 52 weeks. And that's likely going to go up because there's not a whole lot of rain, no moisture in the forecast over the next week to 10 days. And that's happening right at the wrong time as this crop's about to bring dormancy here coming into the spring.
Thanks, Mark. Mark Pullman, what do you think are the main themes affecting the soft markets this week?
Well, in cocoa, the main theme is too much supply and not enough buyers. They've had high farm gate prices this year that Ivory Coast and Ghana established, brought a lot of cocoa in, but you got buyers not interested in paying those high prices. They're considerably higher than the world price right now. So the question becomes what to do with these crops. They're already harvested, some even reportedly rotting. Ivory Coast did commit to buy 100,000 tons, but some question what they're going to do with it. Ghana has already taken steps to lower the price for sales going forward. Ivory Coast considering that, but not till the mid-crop, which starts in April. So we've got this burdensome supply. We've seen now the market go down, hovering around $3,000 a ton after being as high as $13,000 in 2024. And we spent prior to that rally, we spent much of the decade prior to that sitting between 2,000 and 3,000, and we're back in that range now. So question becomes, when will buyers step in? But they're certainly not interested in paying those high farm gate prices. Over in coffee, we're just seeing technical selling pressure and good Brazilian growing weather. The market broke below a 5-month consolidation at the end of January that projects down to 250, 265 in the May contract. The harvest for that Brazilian crop is still 2 to 3 months away. And cotton and sugar are oversold. Sugar fund net short is at a record level, cotton at a near record. This does leave both those markets vulnerable to short covering. And both of them kind of reacting to low prices in that, for example, in sugar, we're talking about lower beet plantings this year, reduced cane investment, and a switch to ethanol, more focus on ethanol in the coming season. We do expect another global surplus this year, but not as big as last year. And in cotton, we're seeing a pickup in U.S. exports. The number in last week's report was almost 500,000 bales. That was for the week ending February 12th. That was for not only for the largest for the marketing year so far, but it's the largest for any week since October 2023. We've also had 6 weeks above 200,000 bales and 4 of the last 6 above 300,000. This is definitely an improvement over where we've been. The tariff issue may not affect cotton so much. There is maybe a concern that the deals have been worked out, which particularly with Vietnam, the biggest buyer, there may be some stickiness on that now that, as Mark and JP mentioned, that that people may want to back out of those deals. But Vietnam's already committed for a lot of cotton this year.
And Mark, what are energy traders looking for right now?
Well, I think in crude oil and the rest of the petroleum complex, the main issue is this threat of war in Iran. The U.S. buildup of war ships and stuff is kind of complete now, and some think it's only a matter of time before the U.S. makes a strike. We do have another round of negotiations scheduled for Thursday, but both sides still seem quite far apart on several issues, mainly the extent of fuel enrichments. And Iran's leaders at this point may view standing up to the U.S. and risking war a better option for their own survival than showing any sign of capitulation to demand. Now, the natural gas market's a little different. We have another forecast for warmer than normal temperatures in the 6 to 10 and 8 to 14 day forecast. Right now, the Northeast and the Mid-Atlantic are experiencing a blizzard. but that is expected to quickly warm up this week. Not much heating demand for natural gas seen down the way. We have a pretty big gap in the April contract from January 20. That's between 286.70 and 272.20. That's an area to watch. We're kind of falling back close to it. And if we move back into it, it would leave the January 9th low vulnerable.
Thank you all. Remember, the views and opinions expressed today in this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.